Okay, morning everyone. Welcome back to Morning Kappa at 8. If you um looking at the Hang Seng Index, I can see that the index right now is moving sideways since the October, right? And but good news that the index remains above 25,000 point level. As long as stay above this threshold, right? We consider the overall technical setup to be bullish, right? And outside resistance stick to a 27,400 point level. Looking at the Hang Seng Index, so overall, right, based on the weekly performance, right, we can see that the bank stocks remains very resilient together with the insurance company AIA Group, right? Whereas last week, I can see that most of the corrections or profit taking happens on the high beta tech stocks like 9988 Alibaba, Xiaomi 1810, right? If you take a look at the all Hong Kong companies, and we sorted out them by the market cap as well as the weekly performance. You can see that the most of the selling pressure, right, it's really happened on the tech sector, right? But there's still some defensive stocks such as the 66 MTR, which Iman have posted last week, right? Have go against the trend, right? Today we do see that part uh, these companies, right? There's two more counters that I like to share with you. Before I continue, I just want to share with you one interesting counter in Hong Kong, which is the Aluminium China stock code 2600. So as we understand right now, aluminium supply is going to be deficit next year, right? That will actually lift the aluminium prices to be higher. Um, so if you're looking at the Hong Kong market, you can actually pay attention to this counter. Apart from that, in the event that the market going for a sharper or deeper corrections, the other counters, which is Sino, Biopharma, usually will outperform in the bearish market, right? And so there's two counters that caught my attention over the week. Firstly, the property counter, Henderson Land Development, stock code number 12. You have a break past the 29 Hong Kong dollar, showing that the consolidations phase is over. Henderson Land is eyeing to test the next resistance at 31 and followed by 33. And also support is at 27. Then on we have a GCL Technology, stock code 3800. Now this company is involved in the renewable energy. Particularly they are producing the solar cell for the solar panel, right? So the company have a break past $1.45. So the breakout, it may move towards $1.60 and followed by $1.75. Downside support is at $1.30. So despite that, the Hong Kong market last week have corrections. We do see that the a bit of the property counters are bucking the trend, together with the solar counters also moving high, such as Sini Solar as well. So you may look at these two sectors together with some of the banks and insurance sector as well. Then on in the US market, right, S&P continue going for corrections. As of last Friday, it has dipped below the 20 days moving average, showing that the bullish momentum decelerating. So let's take a look at the heat map on the S&P 500, right? You can see that the corrections also happen on the tech counter. You can see that Nvidia, Microsoft, Google, over the week, it have actually experienced a strong corrections. But counter like the healthcare, Eddy, they have returned about 10%. And then the banking sectors, mostly also in the green color, showing that these are the same picture that what we see in the Hong Kong, right? The finance counter right now has become more defensive playing when corrections or profit taking happen in the tech sector. Over the week also, there is this earnings release by the Datadog, right? You can see at this page, right? Most of the counters that I'll be looking at is the AI servers, memory chips, semicon utilities, telecommunications, and one sector that I think that we should not forget is actually the cyber security, right? So Datadog together with CrowdStrike, they have delivered a very good set of results, and Datadog share price have even break on a higher high. So again, let's review on the price volume profile. Now you can see that once a share price have moved above this price volume profile, the resistance or the highest volume, right? This highest volume is also a support level, is also a resistance level, right? I'm not sure how what should we call it, but I just call it the volume profile resistance. So once a share, right, can penetrate or break into the this high volume, right, likelihood, right, the sentiment have become bullish. So in the trading, we just have to take a high probability trades. Once you go for breakout trades, you just set a stop loss in the event that results turn sour. But in this scenario, right, the trades have become fruitful, right? The stocks are break into the resistance with a good results, better guidance. That's where the shares have actually moved on a higher high. Now, the other counters that also in our trading list previous week is actually EQT. Now, this company involved in the natural gas productions. The share price have went down for corrections, and but after 1 month of consolidations, the share price have starts to actually break out again, and right now it climbed above our R1, which is 57. Now, once again, you look at the price volume profile. The volume basically is actually at the 51 level, so it shows that this EQT right now the bulls have the technical advantage right now. So despite that the market is coming downwards because the tech stock have a very high PE, right? We may look for some of the defensive play that the counter have a very minimum of debt and high cash generations. Now, if you look for counter that have very low debt and high cash, right? I think there will be two sector, either auto sector or it'll be oil and gas sector. Same go for Malaysia. Look at our oil and gas counters. Mostly are very low debt because over the years, bank do not want to lend money to oil and gas, but they are so far cash generating. So you can see that the EQT have break past the 57 right now, heading towards 60 and 63 level. Okay, and as for Malaysia market, last week the funds are actually going for defensive or laggard play, such as transportations, plantations, and our financial services has become a defensive play again last week again. So you can see that from Hong Kong to US to even Malaysia, right? The finance sectors has become one of the shelter right now. Okay, I think once the dust settle, right, the finance sectors will be the sectors that are going to lead the market for the next leg on the upside. Right, and FKI still see a bullish right now, despite that we are consolidating sideways. Stop loss unchanged at 1535, and so I think that we are going for the earnings season for Malaysia. So in this perhaps towards the end of the month, more banks are going to release their results, and if that turns to be fruitful, right? I think likelihood we are going to break up. Now, before I forget, I think last week our bank sector analyst, uh, David, have actually came out a few reports, and they have upgraded the banking sector to overweight as well. So usually we'll meet the banks before they go for a closeout period. So right now, looking at the analyst view, right, they become more bullish on the banking sector. So together with the technical price actions, hopefully our FKLI can break high and move on the high fashions. The FCPO continue experience corrections. Last Friday, it continued to experience profit taking, and today, 10th of November, we're gonna have the um, stats by NPOB on the October data, right? But so far, the prelim survey number by Reuters and Bloomberg shows that the productions still remains high, and our stock level have stubbornly stay above 2 million tons, right? And even next few months, the going for a low production cycle, but the market is actually taking this period to profit taking. So on the downside, support will be 4050 and followed by 4000. And so far, we keep our stop loss unchanged at 4004. So as long as FCPO stay below 4004, we'll keep the bearish bias unchanged. And as for the trading counters this morning, firstly, we look at the QL resources. They have a break above 4 ringgit and 20 cents, eyeing to extend their counter-trend rebound towards 4 ringgit 40 cents and followed by 4 ringgit and 55 cents. Downside support is 4 ringgit and 5 cents. Now, secondly, we have Zitrix with a break past the 84-cent resistance, heading towards 88 cents and followed by 92 cents. Downside support is 80 cents. So we have QL resources and followed by Zitrix AI. So I'll stop here and pass on to Sian on the weekly Rasa Mingguan. Thank you.
Thanks, Joseph. So, good morning, everyone. Just a quick update from our weekly slides or report as per 7 November 2025. So, as what we actually pencil in our Rasa Mingguan report, we do see that the RHB risk sentiment index has declined below 1, so indicate a softer global risk appetite. So we do believe that the primary driver of this pullback is investors' reassessment of expectations for a US federal funds rate cut in December. Swap market pricing now implies close to 70% probability of a rate cut compared to over 100% prior to the October FOMC meeting. So despite the decline in our index, so we do not interpret this as a sell-off signal. So rather, we view it as a knee-jerk reaction to our shifting rate expectations. So secondly, our central bank views have largely materialized, with the Reserve Bank of Australia maintaining its official cash rate at 3.6%, while the Bank of England kept its benchmark rate steady at 4%. So for Malaysia, Bank Negara Malaysia has also left the overnight policy rate unchanged at 2.75% as per the last MPC meeting of the year, so on last week. So we maintain our forecast for the OPR to remain at 2.75% through 2026, although we do note that the balance of risk is tilted towards a potential 35 basis point cut should the downside risk intensify. So thirdly, our constructive outlook for 2026 is further supported by recent robust ASEAN data, so suggesting a strong year-end performance. So Indonesia and Thailand manufacturing PMIs, for instance, both accelerated in October. So while the Indonesia GDP and export growth has also exceeded the expectation in the latest releases. So conversely, uncertainty surrounding the US government shutdown remains unresolved. So incoming data indicate continued softness in the manufacturing activity. So while the private sector data point to elevated layoff announcement with 153k job losses, and which is 175% year-on-year increase and the sharpest rise since March 2025. So in our view, this lackluster labor data will likely reinforce risk of sentiment toward the US growth assets. So closer to home, so on Malaysia, we have also seen the release of the IPI, which is the industrial production data for the month of September on last Friday. So the September's IPI has also increased by 5.7% on year-on-year basis, which is an improvement from August print of 4.9%. So and also higher than our in-house projection of 5.2% and Bloomberg consensus estimate of 5.4%. So given the stronger than expected year-to-date IPI performance, which actually grew by 3.1% for the first 9 months of the year, and also recovery in the mining output and improvement in the external trade, we have revised our full year IPI projection upward to 3.6% as well, from 3.2% previously. So, and we do see that the manufacturing sector is expected to receive the near-term support from, firstly, a sustained strength in the domestic-oriented industries. Secondly, easing tariff-related risk, especially following more clarity on US reciprocal tariff on Malaysia, following the conclusion of US and Malaysia reciprocal trade agreement in October. So where Malaysia is expected to receive more exclusions of exports to US, as mentioned in the Annex 3 of the executive order issued in September, which including some parts of computers and also PCs, and also some of the agricultural products. So which including, for instance, palm oil, coca, tea leaf, and also spices. So this the more exclusion under this industry has also give Malaysia some competitive edge over other ASEAN peers. So where currently only Malaysia and Cambodia able to secure the exclusion of exports to US under this Annex 3. Secondly, we're also seeing the easing. Thirdly, we're also seeing that there's a continued resilience in the E&E exports, as per we see in the September data, September trade data as well, which should give the manufacturing data some support going on, and also a steady investment activity. So the sustained momentum in manufacturing and also the turnaround in export performance as per the September data do reinforce our view that the final GDP estimates for the third quarter GDP, which is scheduled to release on this Friday, will likely to remain at 5.2%, which is the pretty similar to the advanced GDP estimates. So with potential upward revision to our full year 2025 GDP forecast to 4.5% as well. So just a bit more on the monetary policy decision, as I mentioned earlier on for November. So as looking ahead into 2026, we do expect OPR to remain unchanged at 2.75% for Malaysia. So with monetary policy likely to stay data dependent in the upcoming MPC meetings. So current developments, including signs of easing tariff and trade tensions, so alongside with solid domestic demand, so do not really indicate another OPR cut in 2026. So we continue to project GDP growth at 4.7% and expect inflation to stay manageable on next year, averaging at 1.8%. So while it is not our base case, the balance of risk is tilted towards a 25 basis point cut should the tariff risk intensify in the following year, resulting in GDP growth falling below the lower end of the official 2026 projection of 4 to 4.5%. So in the November MPC statement itself, the central bank has sounded more optimistic about the global outlook. So noting that the conclusion of more trade negotiation has eased global uncertainty, while maintaining its positive overall economic assessment in domestic economy. So that's all from me. I'll pass the line to the next presenter. Thank you.
Hi, thanks, Sian. Moving on, this is a healthcare sector update. Basically, the report talks about the upcoming third quarter results preview. So in terms of the sector, we are maintaining our always stance for the sector. In terms of third quarter 25 results preview, healthcare providers under our coverage, if you recall, first half is particularly soft, which is weighed down by seasonal factors and ongoing payer pressure, which drove margin pressure, as well as structural shift in the case mix towards daycare rather than inpatient admissions. For third quarter 25, we do foresee IHH and KPJ reporting 9 months core net profit, broadly in line with our expectations, both representing 73% of its 2025 forecast. Meanwhile, for dual pharma biotech, we didn't publish a report on this, but we are expecting a seasonally weaker second half 25 as it benefited in first half 25 from stronger than expected insulin sales, while fourth quarter 25 will likely be impacted by the government halting orders from mid-November onwards. In terms of recent news flows, the recent news flows highlights increasing intervention by insurance payers in how patient care is being delivered. Broadly, we understand that the negotiations with insurer payers happens on two fronts. First is between hospital and insurer payers, and secondly is between insurers and specialist consultants. Discussions with hospitals have appeared to have progressed, with discounts already extended to insurers. However, negotiations with specialists remain unresolved and are likely to be more complex given the large number of practitioners involved. And unlike hospital employees, specialists operate independently and have discretionary over drugs, consumables, implants, and procedures that they use. Some of which, while deemed medically necessary, may fall outside of hospitals' agreed terms with the insurers. Although hospitals may encourage adherence to internal guidelines, but compliance is not guaranteed. And potential implications from this could, include softer inpatient and outpatient footfall as trust is being breached, especially with the growing adoption of co-payment mechanism in the insurance coverage. Of the two hospitals under coverage, any adverse impact will be potentially greater for KPJ, given its domestic concentration. And despite that, our topic remains KPJ. We think that it should still trade at a wider premium compared to IHH, and this is supported by its superior margins as well as ROE, upside to revenue intensity alongside improvements contribution from hospital under gestation, which together provides higher earnings visibility and margin expansion. In the report, we also upgraded the target price for IHH and KPJ. We increased the target price of IHH to 9 ringgit and 15 cents from 9 ringgit previously. In terms of earnings adjustments for IHH, we lift the earnings by 13%, 5%, and 14% upwards. This is to reflect updated operating assumptions from its business in Acibadem as well as India, and to adjust for FX and margins assumption. And for KPJ, we did lift the target price to 3 ringgit and 08 cents from 3 ringgit and 05. We tweaked our core PATAMI forecast for KPJ by upwards by 1% for 2025, but lower at 2% and 3% for 2026, 2027 to reflect adjustments to our interest and lease expense assumptions. We also updated some of the key DCF assumptions, including a lower risk-free rates, a higher cost of equity, as well as a lower weighted average cost of capital as we tweak our debt to equity ratio assumptions. And that's all from me. Key downside risks to our sector core would include higher than expected operating costs, lower than expected patient visits or revenue intensity growth, as well as adverse regulatory changes. That's all from me. I'll pass on to the next speaker. Thank you.
Okay, good morning. We move on to Maxis's third quarter results. This is basically the third quarter 9 months numbers. Results were basically a beat. Third quarter core earnings 412 million was up 4% Q on Q, 13% year on year. 9 months numbers in terms of the same core earnings 1.2 billion, so that's up 10% year on year. Basically at 82% of forecast, consensus about 79%. They've also declared a 4 cents dividend. This is the third interim. Cumulatively, that number is now at 12 cents or about 80% payout. So relative to our numbers, the outperformance basically stemmed from two things: stronger OPEX efficiencies as well as lower depreciation. Management has lifted full-year EBITDA guidance to mid-single-digit growth from flat to lower single-digit growth. As you know, this is actually notwithstanding the seasonally higher device costs in fourth quarter of 25. You have the full impact in terms of the fourth quarter from the launch of iPhone 17. So acquisition activities tend to actually pick up over the last 2 months of the year. So we do expect that seasonal OPEX to come in. Overall, we've lifted our 25 to 28 earnings by between 10 to 14%. This is mainly to adjust for further OPEX efficiencies and some adjustments in terms of the wholesale side of things as well. Just want to point out that the cost excellence framework, they've done very well in terms of managing the cost. On a staff cost basis, it's down 8% Q on Q, but staff cost rationalization isn't the only thing that they're looking at. There's still other or more room for cost to come off. That's on the digitalization and network optimization, which is another key cost lever that talked about. Okay, very quickly in terms of the segments, I think in terms of consumer mobile revenue, both pre and post actually rose Q on Q. The added higher subs, both pre and postpaid. ARPUs have been fairly resilient despite competition, within the prepaid side of things. Fixed network solutions sales, this is actually part of the enterprise business, also did fairly well this quarter, was up 3% Q on Q, almost 6% on a year-on-year basis. That's really coming from very lumpy project recognitions. And, for those of you who've been following Maxis, you will know that, the enterprise side of it, you see fairly, lumpy sort of project revenues on a quarter-on-quarter basis. So this quarter is no exception. Seeing a bit of more lift in terms of the FNS line. Overall service revenue, this includes both enterprise and consumer, was up 2% Q on Q, 1.3% year on year. So pretty decent there, and for the fact that overall market is actually pretty soft. In terms of capex, they've guided 1 billion for 25. 15% of this will be for 2 high capacity terrestrial fiber routes, running the length of the peninsula. They did indicate that about 39 data centers are basically connected to their fiber networks. Their fiber network has been deployed across the nation, and it's actually available in more than 100,000 business premises nationwide. Some updates in terms of 5G. The call and put option the MNOs have with DNB, which is the previously the single access 5G seeker, or rather the 5G access provider. It's coming to an end soon, towards the end of the month. DNB has got an option to exercise this, its put option, within 1 month of the grace period, which is between 30 November to 12 December. So if the MOF does not exercise the put option, MNOs can look to exercise their call options with MOF a month following that. So the whole lapse of that put option will be sometime in middle of January of 2026. We're not ruling out an extension of the call put option. I think MOF's presence may still be needed to alleviate the debt of about close to 5 billion at DNB. Digital National Brown obviously is still making losses, and there are other obligations that require MOF's cloud to actually address. So we think that that call and put option may not necessarily be exercised by the end of the month. Just to also point out that Maxis has gotten additional 20 megahertz of the 2100 spectrum recently. This was early part of this month. They've been in discussions with MMC on new spectrum assignment, all that. So they've gotten additional 20 megahertz on DNB in itself. I think there was a ministerial direction issued just almost 2 weeks ago. This is basically an additional 100 megahertz coming back to them. Though the earlier 100 in terms of the 3.5 spectrum has been clawed back and assigned to U-Mobile, which is the second 5G access seeker. So in terms of spectrum side of things, I think it's pretty much positive for both DNB in terms of additional 100 megahertz coming back, and obviously Maxis has benefited from the additional 20 megahertz of 5G spectrum. Or else, if you look at the numbers, pretty decent set of numbers. They've actually been doing fairly well in terms of operational performance over the last couple of quarters. Share price has actually rated quite a fair bit in recent weeks. We've actually upgraded our TP to 425 in response to or in tandem with the increase in terms of forecast for the next 3 years. So we're keeping our neutral call at this point in time. Yields are just over 4%. Target price, the new target price of 425 implies an upside of about 8% from the last close. Okay, that's all from me, and I believe that's all from us for today. We'll see you again morning cover tomorrow morning. Goodbye.